Welcome, everybody. This is Axel Merk, President and Chief Investment Officer of Merk Investments. I'm recording this on Monday, the 14th of January, after market close. To provide you some context, we've had quite a ride in the market since the most recent chart book available. As always, Nick is the driver in preparing these charts. This is my interpretation. You can download the charts at merkinvestments.com/research. And as always, we first show this valuation indicator, which is mostly an auto regression of the data onto itself, which just means that currently equities are valued richly versus bonds. And if there's any predictive power in this, then this means that the returns over the next 10 years may be very, very minor. And it's really a frame of referencing. It's difficult to devise a strategy based on this. And so similarly, of course, any of the other indicators that we do have, they give a glimpse. And by the time you have absorbed everything, all the markets may have moved. And so a lot about investing, in my view, is about risk management and how to adjust one's own risk profile as one moves through the economic cycle in the context here of the equity markets. And of course, we got our business cycle chart book separately. A lot have been made about earnings. Clearly, we had a gangbuster earnings year in 2018, and that's expected to slow down for several reasons. But the one thing I like to point out, that's obviously not in these charts here, is that if we do have more wage pressures, then that may also be a headwind on earnings. Many of the companies in the S&P 500 sell internationally. International markets have been weaker than the US domestic market. And so as far as I'm concerned, it is perfectly feasible for the US consumer, which drives US GDP, to do very well, whereas equities might be a bit sluggish. The business cycle is doing just fine as well. And obviously, I say that in the context of, if you listen to commentators at the beginning of this year, including folks at the Fed and including Fed Chair Powell, who said, I get it, when the markets were coming down, bonds were rallying, markets being risk assets were coming down. And basically, the S&P 500 and many other risk assets suggesting a slowdown might be imminent or might be pronounced already, and the market pricing in rate cuts already for this year. Well, if you look at the US business cycle, it hasn't hit home yet, so to speak. And clearly, when the economy slows down, it starts at the weakest point, which may well, in this case, in a global market, be somewhere abroad, and slowly but surely then make it into riskier assets, into then the quote-unquote safer assets towards the end. Now, talking about the global growth backdrop, the Chinese PMI, that's the gray line here, has dipped below 50. And so Chinese data have been coming down. And the 50 is kind of the line of where, at least according to the construction of PMI, it might indicate a recession. But we've seen several other indicators come down, including here the US PMI come down as well. The German PMI has come down. And so everybody who says the glass is half empty has been confirmed by what's happening. Now, what doesn't 100% jive in this is that if you take a place like Germany, some businesses don't find workers, or many don't find workers, because the unemployment rate is incredibly low. So they're really constrained on that angle. Now, international trade has come down. We've just had some trade numbers from China. So there is a slowdown. At the same time, markets are forward-looking, and Chinese are taking initiatives. Now, the Chinese have said they're not going to use the same traditional initiatives that they've always used because of the unintended side effects. And so there are initiatives being taken to get China around the corner. A lot depends on where you think the trade war is going to head. But without jumping around too much, China is really one thing you want to focus on because China is so big. There's a lot of talk about other factors these days, such as Brexit. And as Nick has pointed out, the UK is 3% of global GDP. Don't tell that to any Brit. But beyond that, the UK economy isn't as relevant to the global economy as it used to be. Clearly, the There's interactions, especially also to Europe, but let's just keep that in mind that China is the bigger elephant out there. Financial conditions, according to this particular index here, is doing all right. Nothing to be too concerned about. Now, if you look at some other metrics, there's been more tightening. Now, there's been some talk about the sell-off of high-yield assets. Well, much of it, there has been some sell-off, definitely, but a lot of it has been just the widening of the spreads, where some of the riskier debt hasn't actually sold off so much. It's just that treasuries have rallied a lot. And so those so-called spreads have widened. And yes, that's a concern. But one thing I like to point out is that if you look at before we had this onset of the risk-off period last fall, we had substantial negative positioning on treasuries, meaning people were short, betting very heavily on higher rates. And then as at some point folks started to switch forward and look at 2019, several commentators came out saying, hey, economy in 2019 is going to be slower. And I would even call it a short squeeze in those positions in treasuries has come about. So a massive rally in treasuries. And that in itself became a self-fulfilling prophecy, where then the naysayers, the bears, came out and said this economy is going to go to an immediate recession. And to a significant extent, I wouldn't be surprised if this is a reading of kind of the markets and then making the news match to it. The reason we use the Chicago Fed index is because that one is a fairly, I'll call it a dry one, is a reasonably good indicator of how financial conditions are from the point of view how the Fed should look at it. I say should because we've had the impression that they would look at it that way. But when the market threw a tantrum, Mr. Powell said, we get it, there is some flare-ups in various corners of the markets. Market breadth, that's our own unique indicator. Market breadth has been deteriorating, but isn't quote-unquote horrible yet. It's kind of expected to weaken over the years as a bull market ages. Sentiment was down quite a bit just the beginning of the year or late last year, has recovered to kind of more normal territory. This way of looking at market and debt shows things are all right. The challenge with the bear scenario for the economy, at least, is that consumer spending is doing just fine. As I indicated earlier, corporate America might have some issues. Now, obviously, when you invest in corporations, not in the consumer necessarily. And so, do you follow the mantra that that you're going to be invested as long as the economy does well, and you only want to be on the sidelines in bear markets? And before I get to that, let me just explain this chart here. I'll have you read the details here. I don't want to explain it too much. But in a healthy market, you have a lot of dispersion of risk, meaning your diversification kind of works. In a panicked environment, volatility goes up and everything is highly correlated. And so from a contrarian point of view, you may want to invest when everybody else panics. And so we are not in a panic zone yet, so to speak, but we've certainly come up from this complacent environment, as if I want to call it such. And I come back here to the risk management point of view. In my view, you might, as volatility rises, for many reasons, I often use the Federal Reserve, that QE, compressed risk premium, quantitative tightening, helps expand risk premium, volatility goes up. So if you have, think about as you as an investor or a generic investor, if you have a risk tolerance of X, well, if volatility rises, and especially if it rises above your X, then sure, you might want to diversify. And I think one of the fallacies that many investors make is that let's say I have a 60-40 allocation, 60% stocks, 40% bonds. And I'm not saying it's a bad strategy, but clearly the volatility of stocks had been suppressed for many, many years. And so a 60% stock allocation for several years is much less painful, especially as prices have been going up and up and up, than a 60% stock allocation now. And so if you sit across from your investment advisor and he or she tells you, what level of equities are you comfortable with? Well, nobody has a clue because you haven't gone through this gut-wrenching period of higher volatility. And so you may want to think about how you define risk for yourself, and we can help you if you want to kind of think about those sort of issues. You want to have some ideas. But it is not surprising volatility is up. The other part of that is, and just that you study this chart here in the background, the other part of it is that as the markets move higher and you want to diversify or think about diversification, and then you think about a recession coming up potentially. What is it? What is it about recessions? Well, recessions historically have had very poor performances in equities. And if you find the chart that Nick talks about at some point here, let me maybe go back to this, about when markets have been coming down in recessions, they are, well, we don't have it here, so let me jump around here. When markets have been going down in recessions, they've been going down in a pronounced long-term way. And Nick argues that, hey, if the market, quote unquote, crashes, there isn't much you can do about it because market timing is very difficult. And as a long-term investor, you may just have to sit through that. And he has, in our internal discussions, has compared what we've happened in recent months to some sort of kind of a slow motion crash. Now, I agree to some of that. The thing about the dot-com boom, for example, or also in 2007, we've seen many things that have alerted us, if you call it 2008 one, a crash, right? That should have gotten us out of the market. Now, these metrics that we use, I should have taken you out. We didn't produce those chart books then. We did caution investor back then to be very careful, and I personally got out of my equity investments in late 2007 because I was very concerned. I say all this because there are several different ways to look at the markets, and it's about managing risk. Now here, the technicals, and we're not a technical shop for the most part. We obviously do look at some technicals. That picture doesn't look great. And so going forward here to where we are right now is we got some positives, we got some neutrals, we got some negatives. So we are in very late stages of this bull market. And if you're somebody who wants to max out the period to be invested in, that, well, not everything is flashing red at this stage. Based on this analysis, there is a good chance the economic cycle is not over. And based on that analysis, we might be reaching new highs in the S&P. And so are you worried about missing out, or so to speak? And if you are, the question I would like to ask is, well, what is your investment objective? What are you trying to achieve with all of this? And I think that people tend to forget that because most people don't have 100% of the money in the S&P 500. And so how do you make that sort of allocation? Some food for thought here. Summary that Nick has provided. The one thing, well, a few things to point out is China. China kind of the most relevant one because it is the big elephant out there. The UK, I kind of alluded to that it's 3% of world GDP these days. And then QE and QT, quantitative easing and quantitative tightening, may well have an impact on the increased volatility. And I wrote a newsletter about that to go into more depth as to the implications of that and how the Fed thinks about it or has been flip-flopping on that. That's in the Merk Insights section on our website that you can find there. Please read the disclosure. Please tell others about this and give us some feedback. Hope you're having a good day. Thanks, then. Bye-bye.